Good evening, everyone, and welcome to this evening's PRC virtual class, Historic Tax Credits and Tax Abatement. My name is Danielle Del Sol. I'm the Executive Director of the Preservation Resource Center, and I'm so glad to welcome you tonight to this course, which is going to be led by two real experts in the topic. Nathan Marx and Jason Riggs with Historic Pro NOLA have done dozens. Gosh, I don't even know how many. I'm excited to have them tell us the actual number of renovations, house histories, you name it, tax credit projects across the city of New Orleans. So they truly have an in-depth knowledge of how to do historic tax credit projects, when it works, when it doesn't work, and real tips for you all tonight to help you along your journey. Before I hand it over to Nathan and Jason, I want to thank the people that have made tonight's programming possible. First and foremost, the members and the donors to the Preservation Resource Center of New Orleans. As you all know, we're a 46-year-old nonprofit, and we rely on the generosity of our members and donors to keep our work going all year round. So for those of you who aren't members, please consider joining. A membership starts at just $35 a year, and you get lots of great stuff in exchange. You get our award-winning magazine, Preservation in Print, delivered to your home 9 times a year, and you get discounts on fabulous merchandise, including tote bags, our book, as you can see behind me, tour tickets, and much more. Speaking of tour tickets, yes, we have not been able to do any tours in person lately, but I'm very excited to announce that tomorrow, October 1st, we are unveiling the details of our virtual holiday home tour. It's going to knock your socks off. So starting tomorrow, you will know more and you will be able to buy tickets to our first ever virtual holiday home tour. So stay tuned. If you don't already get email updates from us, sign up today at our website, prcno.org, so you can be the first to know about our virtual holiday home tour details coming tomorrow. For those of you who'd like to make a donation to help support tonight's event, would like to become a member, would like to buy merchandise, please visit our website, prcno.org. I'd also like to give a shout out to council members Jay Banks and Jason Williams, who both are supporting PRC through Harrah's community support grants that they have designated to us for our Revival Grants program, and we're so grateful to both of them. Thank you, Councilmember Banks and Councilmember Williams. I'd like to also thank the P&C Carroll Foundation and the Louise H. Moffitt Family Foundation for their generous donations to the PRC. So, let's talk about tonight. Let's talk about how this works in case you haven't participated in a Zoom class with us before. You can see us, but we cannot see you. However, we would still love to communicate with you. So please send any comments and questions that you have throughout the presentation tonight to us via one of two buttons. You can either click the chat button at the bottom of your screen or the Q&A button. I'll be monitoring both of those throughout the presentation, and Nathan and Jason will leave some time at the end of their presentation for Q&A, and I will relay your questions to them so that they can answer you live tonight. So go ahead and send those in throughout the program. Whenever inspiration strikes, just go ahead and send it our way. You can also send any tech support questions you might have if you're experiencing any Zoom problems. So that's how things work tonight. Let me introduce our speakers. Jason Riggs was born in Washington, D.C., and he actually attended Tulane University and graduated from the A.B. Freeman School of Business with a degree in finance. During this period, he obtained his real estate salesperson's license and worked alongside a high-end, top-producing residential agent in New Orleans. In 2014, Mr. Riggs established Historic Pro NOLA, a New Orleans-based historic rehabilitation and real estate development firm. Mr. Riggs specializes in historic homes, investment properties with or without tax credit benefits, first-time home buyers, and REO bank-owned foreclosure properties. Jason lives in the Irish Channel with his wife, Susan, and is a swimmer and loves live music, which one day we will all be able to enjoy together again. Nathan Marx was born in Birmingham, Alabama, and he's a graduate of the Eckerd College in St. Petersburg, Florida. He held an array of posts within the field of historic and cultural resource management, including with the National Park Service, local and state museums, city municipalities, and nonprofits in Florida, Massachusetts, Texas, and Louisiana. In 2015, Mr. Marx graduated from Tulane's Master of Preservation Studies program at Tulane University School of Architecture. When not working with historic structures, Nathan enjoys biking around New Orleans, traveling to new locations, which once again we'll be able to do at some point, and enjoying the amazing food scene that New Orleans has to offer. So Jason and Nathan, I'm going to turn it over to you. Thanks so much for being with us tonight.
Thank you, Danielle. I want to take this opportunity first to thank you and thank Danielle for this opportunity. We love the PRC. You guys are tireless advocates of the historic architecture in this city, and your work is great and really helps New Orleans remain New Orleans and stay great in terms of its architecture. My name is Jason Riggs, and with us tonight is Nathan Marx, my associate, and together we are Historic Pro NOLA. We are a New Orleans-based preservation, development, and historic tax credit consulting firm. We are developers ourselves and project managers. We have completed over 70 projects within the state of Louisiana to receive tax credits, and we have a 100% success rate. Today, we are going to talk about historic tax credits, which are a great incentive for your investment projects, and we'll give also a brief overview of the Restoration Tax Abatement program as well, which is another incentive. Can everybody see the slides?
Yes, we can see them, Jason.
Okay. First off, what is a tax credit? A tax credit is a direct dollar-for-dollar reduction in the amount of money a taxpayer must pay in income taxes for a given year. For example, if a taxpayer owes $5,000 in state or federal taxes but has a $3,000 credit, he or she in turn would only pay $2,000 and claim the $3,000 tax credit. Thus, he pockets the $3,000 instead of paying it out in the taxes. What is historic? So here you can see we have a modest single shotgun that is located downtown. And this was from a few years ago. Hopefully it's been lovingly restored by now, but I'm not sure. And on the list on the left are attributes of the property which are historic and are features that have significance. In the picture, you can see we have highlighted or outlined some of those features. So we're going to start with this, the door. Is it historic? You can barely see through the screen door, which is in fact historic. But I believe there's a 4-panel door there, and that is a historic feature, probably an original feature of the building. Next, we're going to go over here to this window. Is this historic? The answer is no. You can see that it is what looks like an aluminum replacement window, which was put in when the building was altered at an earlier time, but is not original. It could be fitting inside of the original opening, but the window itself is not historic. Lastly, here we have the stoop stairs. This one is tricky because some would think that they're historic, some would not, but in fact they are historic and they are a feature which the tax credit reviewers care about. And again, the list on the left is a more exhaustive list of the features which we want to talk about and lovingly restore. The tax credit programs. Basically, there are 2 historic tax credit programs, the federal program, which is administered by the National Park Service, and the state commercial program, which is administered by SHPO, the State Historic Preservation Office. In many ways, these programs are similar, if not identical, but there are a few key differences which I will go over as well. So, the federal credit is 20%. The first criteria that the property must meet if you are thinking about possibly pursuing historic tax credits and the federal credit is that it must be located in a National Register district. As you can see on this map, all of the purple areas that are shaded are National Register districts. And this blue square right here is the single modest shotgun, which I showed you on the previous slides. The other way you can obtain the federal tax credit is if you are not located in a National Register district, the building can be individually landmarked and listed on the National Register of Historic Places. All of the stars that you see on this map are individually landmarked buildings which are on the National Register. Some of them, as you can see, fall within the National Register districts, but some of them do not, some of these outliers. So because these outliers, even though they're not in a National Register district, because they've been individually landmarked, they are eligible for the federal tax credit. For the federal eligibility, so we just went over number one, they must be located in a National Register district or be individually listed on the National Register of Historic Places. The building must be at least 50 years old and been constructed during the period of significance. All of the National Register districts have a span of time which is considered the period of significance for that district. And so the date of construction must be dated within that period of significance to qualify or be individually listed. Third, the property must retain most of its original exterior architectural integrity. Does it still read as historic? Is the massing the same and the building form the same as when it was built? It doesn't mean that there can't be features which have been altered over time. It just means that it can't have been altered beyond recognition of what it originally was. Fourth, after the rehabilitation, in order to claim the federal credit, the building must be held for 5 years as an income-producing property, and it cannot be owner-occupied for the most part. If it's a multi-unit building, one of the units can be owner-occupied, but the costs associated with rehabilitating that unit are not eligible costs in terms of earning the tax credits. The fifth one, substantial rehabilitation test. The substantial rehabilitation test is basically you take the value of the property, let's say a purchase price if it's something that you're gonna buy. And from that purchase price, intrinsically, some of the money you pay is for the land and some of the money you pay is for the structure, but it's all grouped into one. So what you need to do to figure out the substantial rehabilitation test is to back out the land value, place a fair market value on the land, and then subtract that from your purchase price. And what you have left is the value of the improvements. So let's say, for example, there's a property which is purchased for $160,000 and lots in that area, if there are any available, would sell for give or take $60,000. So you would subtract the $60,000 from the $160,000 purchase price and you would be left with $100,000. To meet the substantial rehabilitation test, you would have to spend $100,001 or more rehabbing the building in order to meet that threshold. Sixth, the rehabilitation must be done according to the Secretary of the Interior's standards for historic rehabilitation to ensure that the historic character and integrity of the building is preserved. And that is a guidebook which was put out by the National Park Service many years ago, maybe 30 to 40 years ago. And it basically tells you what is acceptable and what is not acceptable in terms of the treatment and rehabilitation of historic features on these buildings. The state credit. The state credit is also equal to 20%. And again, the property must fall within certain map boundaries. Many of these state commercial districts, which are shown on the map right here, also fall or overlap with the National Register districts. And so when you have a property which overlaps and is located in both, that's when you're eligible for the full 40% incentives. If it only is located in one or the other, you're only eligible for 20%, either state or federal. And again, you can see the little blue square here is our single modest shotgun. It is located in the Tremay 7th Ward State Cultural District. For state eligibility, it's a little bit different than the federal. Again, it must be within those map boundaries of a state cultural district, or it could also be located in a downtown development district, or again, be individually listed on the National Register. Same as the federal, the property must be at least 50 years old and have been constructed during the period of significance. Third, it must still retain its historic integrity from the exterior and still read as historic. Again, the fourth item is that it must be used for income producing properties and cannot be owner occupied. One of the major differences is that there is no required holding period for the state credit. So where the federal credit has that 5-year required holding period, the state credit does not have that. And the last difference is that the substantial rehabilitation test must not be met. In order to be eligible for the state tax credit, you just have to meet a minimum spending threshold of $10,000, which, as most of us know who have historic homes, even just sanding the wood weatherboards and doing a paint job or other things like that, fixing old windows, you can easily spend $10,000. So it's good that we have these incentives to help recoup some of those additional costs of caring for a historic building. And lastly, same as the federal, all of the rehabilitation work must meet the Secretary of the Interior standards for historic rehabilitation. So again, if you have a building which is located in both, you can get a combined benefit of up to 40% tax credits on your eligible rehabilitation costs. How do you figure out the credit? So here's an example to figure out the credit. If a developer has a building and they spend $110,000 rehabilitating it, and they would get 40% of their qualified costs, qualified rehabilitation expenditures, QREs. So they spend $110,000, but some costs don't count. Let's say $10,000 is site work, landscaping, and things like that. Those costs don't count. So 100,000 of the costs count, and we would multiply that times the 20% if it's a state or federal project, or the 40% if it's a project that has both. And then we would receive a $40,000 tax credit, 20,000 state, 20,000 federal. The other few costs besides site work, landscaping, site work and landscaping that don't count are parts of the house, such as kitchen cabinets and appliances, which are not, they're not part of the house. One test that I've heard people say is that if you take the house and you flip it upside down, anything that moves and is not affixed in place does not count. Kitchen cabinets wouldn't move, but they don't count. And then landscaping, fences, site work, and driveways. So there are many different entities and stakeholders, review bodies involved in a successful historic tax credit project. First and foremost is the owner or developer who is putting all of these people together as the project team. Secondly is the preservation consultant, should you choose to use one, which we highly recommend. You want to get a preservation consultant involved early in your project because they're going to save you time and money in terms of submitting the applications in a timely manner, as well as consulting you on what alterations to the building and the floor plan will work and be in line with the Secretary of the Interior standards and what things won't. Another integral part of the project team is the architect or engineer. They're going to be drafting the plans which are submitted potentially to the city for permit, as well as plans and elevations which would be submitted to SHPO and NPS for the tax credit reviewers to review and approve or comment on. Obviously, the contractor, you want to pick a contractor that has extensive experience in working on historic buildings and knows how to treat them. It's much different than new construction in terms of dealing with some of these older materials, wood siding, plaster elements, slate roofs, other things like that. And then finally, lender and accountant. Obviously, the lender is integral because not a lot of people have a lot of cash to put into these buildings without getting a loan or construction financing. And an accountant is someone that can consult with you on the tax benefits of the tax credits, how you can utilize them with your own personal return, and help you with certifying your costs at the end of the project. Other review bodies in terms of local reviews are the HDLC and the Vieux-Carré Commission, if you are located within those districts, safety and permits for your permitting process, and then in turn, SHPO and NPS, who review your tax credit applications and then comment or approve or deny them. I'm going to turn it over to Nathan Marx now, and he is going to go over a project which we did a few years ago on Dauphine Street.
Hi everyone, my name is Nathan Marx, and I'll be talking about Dauphine Street. So as you can see here, this is a very traditional double shotgun that's found throughout New Orleans. But also I want you to take a look at it on the left, which is what it was originally. As you can see, it really didn't need that much work to it. It was, you know, you could already live in it. So to take advantage of the tax credits, you don't necessarily have to be a completely blighted building. It can be one that just needs to be restored and updated and still qualify for historic tax credits. Okay, so historic tax credits follow a three-part system as far as applications go. There's a part 1, a part 2, and a part 3. The part 1 is called the evaluation of significance. So basically what this means is this building historic? Does it retain its historic integrity? And as you can see from the picture before, that building does retain its historic integrity. It still reads as a double shotgun, and it has character defining features on it. As Jason mentioned earlier, this building is located within both a federal and state map. This one is located within the Faubourg-Marigny National Register District and the St. Claude Cultural Corridor. So this property was eligible for the full 40% historic tax credits. You also need to conduct historic research on your property to find out kind of when this building was constructed. It doesn't have to be exact, but you should try and pinpoint it within a decade, basically, to determine if it's within the boundaries of that National Register period of significance. You also need to fully document your building, both interior and exterior, and you'll have to also create as-built floor plans, which show the building in the as-is condition of when you bought it. So those photos that you took, the documentation, you're going to key it to the map of the as-built drawings. And the last thing you're going to have to do is you're going to have to describe, why is this building significant? How does it contribute to our understanding of this National Register district? As you can see here, this is the documentation I did for the part 1 at Dauphine Street. You can fully see the entire room, but you also see that the building really wasn't in that bad of shape. It just needed to be updated. So just once again, want you to know that tax credits doesn't have to be a completely blighted building. Anyone can really take advantage of these credits. So part 2. The part 2 is going to be the meat of the project. This is where you're going to be describing very, very in-depthly everything you're going to be doing to the building, both interior and exterior. This also involves fully documenting the building, once again, both interior and exterior, keying it to the same as-built floor plan. You'll also be doing a narrative of describing every single line item that you'll be doing to it. So let's say you're going to be doing foundation work and you just need to tuck point the piers. You'll be describing that. But let's say you really need to do something major with it. You need to raise the building for the flood elevation up to be 3 feet. And you'll be describing that as well. So it could be minute to something major that you'll be describing, that you'll be doing to the property. You also need to supply window specs if you're replacing anything, or door specs, or even trim specs. Let's say you're replacing brackets in the front, they'll want to see what the dimensions and style that will be going into it. As you can see here, this is the documentation for the part 2. And you can see in the first 2 photos that that's the interior, which shows the flooring and the exposed framing. But then also you can see on the exterior right there that it shows just the minute fretwork that they'll be millworking, and then also something so minuscule and kind of boring as the shed. But everything needs to be documented and described that you'll be doing to the property. Okay, part 3. The part 3 is kind of a before and after, the wow factor. So basically the part 3 is proving everything that you said you were going to be doing in the part 2, you did. And once again, you're going to fully document the building, key it to the proposed floor plans that you made, and then show them basically that, yes, I did complete and do the work that I said I was going to do to the specifications that I said. As you can see here, this is a nice before and after of an interior space for the project. I think it turned out quite beautiful.
Thank you, Nathan. So Nathan described the three-part application process, the part one, the part two, and part three. One of the things that investors and developers always want to know is, how is making this a historic tax credit project going to affect my development timeline? And that's a great question. A lot of people close on the property, they have loans ticking with interest accruing, and have a dumpster delivered while they're at the closing and want to just start going to town on the building as soon as they close on their construction financing or close on the building. So the part one, the evaluation of determination of significance, that is done. Like Nathan said, we would do the as-built floor plan and key all of the interior and exterior photos to that floor plan from the vantage view the photos were taken, as well as the historical research to date the building within the period of significance and also show where it is located on the federal and/or state district maps. The review time of the part one is, you send it in, once it's completed, you send it into Baton Rouge, and they have up to 30 days to review the application, and then they make a recommendation and then send it up to the National Park Service in DC. Then the National Park Service has up to 30 days to review it as well, and then ultimately they will respond in writing to the person who is the applicant on the application, and you will typically receive that response within the next 10 to 15 days. So you're looking at, from the time it's submitted in Baton Rouge, about a 75-day turnaround period until you have the response. The part two application, it's the same thing. Now, one thing I can say is, obviously you don't want to have two 60 to 75-day review periods. Typically what we'll do is that we will submit the part one and the part two together, and then that way that timeline is running concurrently, and within 75 days or so from when it's submitted, you will have your both part one and part two responses. Now, the part two, as Nathan said, is a very detailed description of all of the elements of the building, both interior and exterior, and their existing condition, as well as a narrative of how you propose to change those elements and or restore them. And so once the review of the part two is done at the National Park Service, they will respond in writing, and there are a couple different responses you could get. Approved, that means everything that you proposed in the application, they agree with, and from there, you just go and build it the way that you said you were going to build it, and you're good from there until you submit the part three. The other response that can happen is an approval with conditions. That means that most of what you've proposed is accurate and they agree with it, but some one or multiple line items of features, they don't agree with what you're proposing to do with them, and they want you to change that. It could be how you're proposing to change the floor plan. It could be a material that you're proposing to use that they don't agree with. Let's say if most of the wood weatherboards are intact and you propose to remove the wood weatherboards and put on hardy plank, then perhaps they would approve the application from all of the other things, but say extant wood weatherboards must remain, repair and replace in kind with wood weatherboards, or if you want to, you can selectively replace a few damaged wood weatherboards with hardy plank, but must be the same in size, width, and reveal as the wood siding. So those are, or the last option, which we've never encountered, is a flat out rejection. And at that point, you have to go back to the drawing board and basically redo the whole part 2 and then resubmit it. The part 3 is the same review period, 30 days at SHPO and 30 days at NPS. And then you get your response for your part 3, your completed work. Again, these timelines are for the combination state and federal projects. If it's one or the other, the review period is less. So if it's only a state project, it's only a 30-day review period for each of these, and then you'll receive your response. If it's a federal only project, there is still this 60 days because SHPO, even though you're not getting state historic tax credits, does still review and comment on the work, and then they ship it up to NPS. One of the things that we have started offering to both realtors and prospective clients, investors out there, are this historic tax credit pre-approval letter. And basically, we can start to vet the property, which either you already own or you're considering buying, and tell you if it is eligible for historic tax credits, either state or federal or both. And the way we do that is typically by going by the site, checking out the exterior characteristics of the building, doing a little bit of research on the building, and seeing when it was built, is it in the period of significance, and also where it's located within the state and federal maps. So here's an example of a property which was on Domain Street, and we vetted this one out and saw that it's eligible for both programs, the federal and the state program. And so we were able to issue this pre-approval letter. This doesn't mean that what you want to do to the building is necessarily eligible and in line with the tax credit programs. It just means that at face value, it will qualify if you're willing to do the appropriate work on the building. But we do always like to take the next step if a client is interested and meet the purchaser or owner and perhaps their real estate agent at the building, so that we can talk to them face to face, do a walkthrough of the building, and hear about what their goals and objectives for the building are, and then determine if those are in line with the historic tax credit programs or not. And sometimes what people want to do are non-negotiable, and they decide to not use these programs. And then other times people are willing to make the changes that they need to, whether they're small or large, in order to receive these benefits. The next program I want to briefly touch on is the Restoration Tax Abatement program, which is a program that in effect freezes your property taxes at the pre-improvement level for 5 years. So let's say in that same example of that $160,000 historic building is purchased, and you're going to do a $120,000 renovation of it. So you would have $280,000 in the building. Well, as we all know, the city of New Orleans goes around, not every year, but they're required at least every 4 years to reassess every piece of property in the city. And when that happens, your taxes can dramatically jump up according to the improvements which you've made to the property. So what the Restoration Tax Abatement program does is it freezes the assessment of the property for 5 years at the pre-improved level. So in this case, it would freeze the assessment at $160,000, and you would pay only taxes on $160,000 of value for the next 5 years, as opposed to $280,000 in value. So the RTA program provides the property tax abatement for the expansion, restoration, improvement, and development of existing commercial structures and owner-occupied residences. The qualifying locations for the RTA program are, recently opportunity zones have been added to the qualifying areas, and opportunity zones came into play when the current administration changed some of the tax code. I believe it was at the end of 2018, it might have been 2017, and created these opportunity zones according to different underserved census tracts, where they were trying to promote investment in these areas both through developing real estate as well as opening businesses, starting businesses, and creating jobs. The other areas that the RTA program is eligible for are downtown development districts, economic development districts, and historic districts. And the historic districts would be the National Register or state cultural districts. So to be eligible for the RTA program, you have to get both local, so City of New Orleans authority approval, as well as state in Baton Rouge approval. And only the improvements are eligible to be abated. So with that example I used before, you have a $160,000 building, the land is worth $60,000, you spend $120,000 improving it, you would freeze your taxes at that $160,000 level. So if the assessor assessed the land at a higher value during that 5-year period, there would still be a slight increase in your tax bill, but typically the improvements are what go up faster. So you cannot take advantage of the RTA program if you have started work on your building already. You have to put in what's called an advance, which will start the application process prior to working on your building, as well as you can't, if the assessment goes up during the time that you're working on it and you pay the taxes on the new assessment, then the RTA that you are going for will only freeze it at that new assessed value. And owner-occupied residences, if the improvements are at least 25% of the assessed value, 25% or more are eligible. This is a small flow chart about the steps required to do the Restoration Tax Abatement program, which can be, but not always is utilized along with historic tax credits. You would file an advance notification to prior to beginning construction, and then you would receive the applications from both the local government, City of New Orleans, and Baton Rouge. The program administrators are Tracy Jackson within the City of New Orleans Economic Development, who's great. I've worked with her for many years. She's very responsive and is a great administrator of the program. And in turn, the same thing of Becky Lambert at Louisiana Economic Development in Baton Rouge. So you would submit the application. They would be reviewed by both Baton Rouge as well as City of New Orleans. Then the City of New Orleans would create a resolution. The Board of Commerce and Industry would have a roundtable meeting which you could attend, and they score your application according to different criteria and then hopefully recommend it for approval. Then the contract would be drawn up. Then at that point, you would already be under construction, you would complete your project, and then once all of the accounting is finished for your project, you would file an affidavit of final costs and project completion report. And then once those are approved at both the city and state level, they would draft an ordinance, which would in turn be passed by City Council, as well as in Baton Rouge, be signed off by the governor, and then your restoration tax abatement would go into effect. There is a renewal, an option for a 5-year renewal on the restoration tax abatement, but it is a lot harder because you have to prove that you've made significant capital expenditures and improvements during that first 5-year period in order to apply and be eligible for the renewal. So that concludes our presentation on both historic tax credits, federal and state, and the restoration tax abatement programs. We hope that you will continue to or start to do historic restoration projects and love these old buildings like we do. Like I said, we're developers ourselves. We love historic buildings, we love New Orleans, and we love playing a small part in helping owners achieve not only much higher returns on their investments, but also helping them to lovingly restore these buildings so that we are good stewards for them. My view is always that these buildings have been here for 100 years or more already. Let's put our stamp on them. update them to modern conveniences and comfortable living for today, but let's let them be here for another 100 years or more as well. So I'd like to open it up to Danielle again, and also for any questions, which hopefully you guys have submitted through either the chat or the Q&A, and we will be happy to answer them. Thanks.
Thank you so much, Jason and Nathan. That was a wealth of information. Jason, if you could stop your screen share, then people will be able to see you and Nathan as you answer all of their pertinent questions. So that being said, everybody send in your questions, type your questions in the Q&A or the chat boxes, and I'll start reading some of these to Jason and Nathan that they can answer to you live. So Anne-Marie wonders, what would the exception of an owner-occupied? So basically the home that she lives in, half of it is a rental. So she's wondering, can she utilize historic tax credits? Her home was built in 1927.
Yes, the answer is yes. And that's a great question because it gets a little confusing. So basically both of the federal and state programs are geared towards commercial property, investment property, income producing property. So what that means is that we'll use the same example of a shotgun double that is purchased for $120,000 and you put another $130,000, so you're in for $250,000. So let's say it's a shotgun double and both sides are in similar condition and you're going to do an identical scope of work to the whole building inside and out. Both floor plans are the same or similar. They're both same square footage on each side. What happens is your benefit gets cut in half because you have the QREs, qualified rehabilitation expenditures. And those QREs are the basis or the multiplier, which you would multiply times the 20 or 40% in order to figure out how much tax credits you would receive. So if you spend $130,000 on the renovation / restoration, and we'll just we'll cost segregate that and say that you spent $65,000 on each unit. So the $65,000 you spent on the unit you live in, those do not count as QREs. Only the $65,000 that you spent on the income producing, your tenant side of your double, are qualified for the historic tax credit. So in this case, if it was a pure investment property and you spent the $130,000 in QREs, you would receive $26,000 in federal tax credits and $26,000 in state credits. But in this example, because you were owner occupying one half, you would only receive 65,000 times the 20%. So you'd get 13,000 in federal credits and 13,000 in state credits. Now, in buildings that are more than two units or multiple units or units that are different sizes. Let's say it's a different kind of building. It's maybe not a shotgun, or it's a shotgun which has been altered at some earlier time so that it's not two equal size units. You would basically segregate your costs as best you could in terms of where you spent the money, or divide it by just an overall cost per square foot, and then you would multiply that times the owner's unit and subtract that out from your qualifying costs in order to figure out your benefit of the tax credits.
Wow, thank you. That was complicated, but you actually made it understandable. Good job. Thank you very much. Okay, I think that you answered this in various ways throughout the presentation, but for any of these either credits or the abatement. Well, for the abatement, you said absolutely no. The question is, can you apply for these credits after a renovation has been completed? And so I heard you very loud and clear. You cannot apply for a tax abatement after the project is complete. You have to do that. You have to start the process.
Yeah, you have to file in advance so that they have notice and it's on their radar and it can slowly be going through the system. It's not that you can't start or do construction during that application process, but you can't retroactively go and try and get it after the fact. And especially for the historic tax credits, that's an absolute no. And unfortunately, we do have clients that reach out to us and say, oh, you know, I just finished renovating this house and, you know, I think it's in the right area and it's definitely old, it's definitely historic. And is there any way we can go after the credits? And, you know, I have a bunch of before pictures. And the answer is, unfortunately, no. It can't be an afterthought. And the reason is that even though owners do have a lot of pictures, you know, everything has to be formatted a certain way. Like Nathan said, you have to have, you know, certain vantage views from every room and certain photos of all of the character defining features, both inside and out. So, you know, to try and go through an owner's photos and key them to a floor plan and then do everything sort of backwards, it just doesn't really work. Not to mention, even though you might think that you know, have done a historic renovation and that everything should pass, that might not be the case. So that's why we as consultants really like getting involved as early in the process as possible, as early as the due diligence period before you're even actually committed to going through with the purchase on the property, so that we can consult about all of these things from the very beginning and in effect save you time and money and ensure the success of your project at the end. You know, we feel like our job isn't done until your tax credits are received. So, you know, we're not only paper pushers in terms of doing the applications and submitting them. You know, we like to do periodic site visits to our projects, and fortunately we have projects all over the city. So, you know, whether we're just in the neighborhood for any random reason, you know, we'll stop by, we'll take 10 or 15 minutes and walk through. We want to keep your train on the track, so to speak, so that as long as you listen to us and what we tell you to do or that you can and can't do, at the end of the project, your project will pass and you will get your tax credits.
That's great. Nick has another great question, which is, can you use the tax assessor's value for land to determine the value of a structure? What if you disagree with the assessed value of the structure?
There are a few different ways to derive the value of the land and the improvements for a site in order to figure out if you will potentially meet the substantial rehabilitation test. One of them is an appraisal. So typically if you are buying a property and there's going to be financing involved, then the bank is going to require an appraisal to be done. And a lot of the time, not all of the time, the appraisal is going to give a site value for the land and then give an improvement value. And so it can be derived from an appraisal, it can be derived from the assessor's website, or it could also be derived from running comparable land and or building sales in the area, and then using those metrics to get to it. You know, what you want to be sure of is that you're standing on firm ground, and you know, when it's time for your CPA to do your taxes or for you to do your taxes, that your numbers are accurate and they are you know, defensible if people want to ask questions about what values you placed on these things in order to you know, be eligible for these programs.
Okay. Anne-Marie asks, am I understanding correctly that one can be eligible for the tax abatement even if not the tax credit?
Yes.
Excellent. Okay. John asks, is there an age for the building to be historic? So you went over that. You said it needs to be at least 50 years old. He says his property was built in 1950. But as you described before, and can you kind of briefly say this again, just having an old property isn't enough. It needs to be in a district to make it qualify for credits. Nathan, you want to take that one?
Sure, that's fine. So yeah, the building, if it's 1950, it could be 50 years or older, but it would need to be contributing within that period also as far as the style goes. So each, like mid-city goes up to 1965, while some areas only go up to 1920. Some areas go up to 1940. So it depends where your property is. And again, the historic characteristics, the character defining features of your property. There's a lot of really great mid-century modern buildings in New Orleans that are character defining, that some of them you wouldn't actually think would be contributing or would be eligible, but actually are. That really, again, it's really a case by case basis.
Thank you. LP is asking about Jefferson Parish. So LP, these programs, the state and federal historic tax credits programs that have been described tonight are state and federal programs. So it's not a parish by parish proposition, but what is different is what National Register or cultural districts you might have in Jefferson Parish. Jason and Nathan, do you have any experience in JP?
Yes, City of Gretna has some gorgeous historic structures which are eligible, as well as Araby, not Jefferson Parish, but a different parish than Orleans. So, you know, if it's an older area, an older developed area, it most likely is located within a state cultural district, and potentially, but not as likely, a National Register district. But there are, you know, places all over the state and country that are National Register districts. So it really is just depends on where the property is located. And again, we can easily help with that and help vet properties, or at least let you know, according to where your property is located, you know, by giving us an address, if it's worth digging into deeper, or if it's just a flat out no.
Yeah. Christine owns a center hall in Mid-City and has a slave quarters in the back that's collapsing. And she's wondering if they'd be able to apply for tax credits if they wanted to restore that back property and make it into a rental unit. But specifically, does she have to rent it out for a minimum amount of time? So it gets to the question of, you know, is it commercial if you rent it out for one day and then use it as your own, you know, she shed for the rest of the year? What do y'all think?
I would say in order to get the federal credit, again, the threshold is a 5-year holding period for income producing properties. So that that collapsing, you know, service quarters would need to be a rental property, an income producing property for those 5 years. One of the things that changed with that tax code revamp and legislation is that it used to be, in terms of the federal credit, that once your Part 3 was approved and your project was certified, that you would receive all of your federal tax credits in one lump. So let's say you spent $200,000, and so you're getting $40,000 in federal credits. Once your Part 3 is approved, you would get that whole $40,000 in federal credits. But again, you still would have to keep it for 5 years, or they would be subject to recapture. So what changed under the current administration is that they've diluted those federal credits. And the way they've done that is now you have to claim it in 5 equal parts for the next 5 years. So that same $40,000 in tax credits, which you would receive at one time before, you would basically claim $8,000 every year for 5 years until you hit that whole $40,000. If you were to revert that service quarter, let's say after 3 years, right, then you would only claim the $8,000 credit for the first 3 years, meaning you would get a $24,000 benefit with your federal credits, but then you could not claim the $8,000 for the last 2 years because it's not an income producing property anymore. Same thing if you sell the property. Again, you can't claim tax credits on a property which you've sold before that 5-year holding period. So you would, again, if you've held it for 3 years, you just would forego the benefit of the last 2 years.
Got it. Thank you. I have 2 questions regarding timelines. when you went through the slide before that said 30 days and you were talking about 30 days or 70 up to 75 days cumulative, Dave wonders, did you mean calendar days or business days?
Calendar days with, you know, a somewhat of a buffer. You know, COVID has slowed things down, but it's getting, you know, back to normal. It depends on the staffing of both the tax credit reviewers at SHPO as well as the National Park Service. I mean, those jobs have turnover like all other jobs. So, you know, it depends on if they have a lot of projects in the queue or not, or if they're caught up. So as soon as they get it, they can start reviewing it. So, you know, the rule of thumb is 30 days, give or take. We rarely see, and 30 calendar days, we rarely see things come back any quicker than that.
What about the tax abatement program? Christian wonders what the typical timeline for that is.
Well, that really depends on your construction process. So, you know, we have clients that do projects in 3 months or 6 months. We have clients that take, you know, 12 or 18 months. For both of the programs, all of the costs need to be incurred within a maximum of a 24-month period. So, you know, it really is up to your construction schedule, because you can't submit sort of the last part, whether it's the part 3 for the tax credits, showing that you know, proving that you've done the work as it was proposed, or it's the restoration tax abatement where you have your, you know, final project completion report and your cost certification on that. You know, you can't do those till all of the chips have fallen and you know exactly where all of your costs were, and you can segregate them all and then turn in that final paperwork.
Sure. Okay, Ken is watching tonight. Hi, Ken. He's a very important historian locally and has done amazing work at the schools. Thanks so much for watching, Ken. And he has a great question. Many people who own a few rental doubles still place them under separate LLC ownership. Are there any complications from how you structure ownership of separate buildings, or do the credits just accrue to the separate LLCs?
I'm going to answer that very carefully because I am not a CPA, nor do I play one on TV. So I try and sort of tiptoe. I mean, there's obviously overlap between all of these things, and we wear a lot of different hats, but, you know, it really depends on your specific tax situation. Is it a single member LLC where ultimately the profits, losses, you know, whatever is going to pass through to your personal return? Is it a multi-member LLC where the profits or losses or depreciation or other positive and negative consequences of these investments are going to flow through equally to each member according to their percentage of ownership? You know, these are all very sort of project specific things that I can't answer, but you know, there are different ways. Like I'll say that for the few investment properties which I've developed using historic tax credits and restoration tax abatement and held as rental properties, in that case, it's either a single member LLC or a multi-member LLC, but with the multi-member, it's just my wife and I, and we file a joint return. So ultimately, the benefits and the credits and everything just flow through the LLC and are claimed on our personal return. But again, you know, that's the kind of territory that it really is to your benefit to consult with your own, you know, tax professional, CPA, in order to figure out what the best ownership structuring you know, is, and how to you know, utilize the credits if you can for maximum benefit depending on your specific tax liability and bracket, etc.
Great. Well, we're coming up on the 7 o'clock hour, but we actually have a few really great questions still to go. So for those of you who are able to hang tight, please stick with us. You'll still learn more. Jason and Nathan, I swear you'll be able to get back to your evening soon. But these really are good questions, so I don't want them to go to waste here. Nick wondered, since you were talking so much about the benefits of using a consultant, what are the range of fees for hiring a consultant for a tax credit application project?
So it really, again, depends on the project. That's another reason that we like to be called out, and we offer to do a site visit free of charge initially to, meet the project team or the owner developer and walk through the project. And it's typically a combination of square footage, scope of work, construction budget, number of units. And from all of those things, we usually determine our fees. A lot of the housing stock in New Orleans are historic shotgun doubles. So, we have some pretty good, fixed fees for shotgun doubles up to a certain square footage. And, if people want to inquire, we're happy to send them our information packet. We actually have a suite of 5 or 6 documents, which are frequently asked questions, our base fees and rates, as well as a very informative article about the tax credit application process and why using a professional and a consultant is a good way to go and will save you time and money. And what costs qualify, what costs don't qualify. Like I mentioned before, kitchen cabinets don't qualify, appliances don't qualify, site work and landscaping don't qualify. But in turn, there are a lot of costs which do qualify. One of the costs that qualify are hiring a historic tax credit consultant. So all of the fees that you would pay us are a QRE. So ultimately, let's just, as an example, say our fees are $6,000. Well, off of that $6,000, you would receive, if it's a state and federal project, you would receive $1,200 additional federal credits, $1,200 additional state credits. So it's kind of, it's again, almost like a rebate on your spending. Now, yes, you do have to come out of pocket with that money to pay and then wait for the tax credits to come at the end of the project. But, these programs are set up this way so that you're willing to spend these extra dollars on the building or on the project team or whatever, and incentivize you to do the work correctly and do the building justice at the end of the day.
Great. Speaking of contacting you, would you be willing to share your slides from tonight's presentation with any of our viewers?
Yes, I would. We can see about coordinating that. I think
our coworker Danielle here put your and Nathan's contact information in the chat box. So how about anybody?
Yeah, that'd be great. If people want to reach out, we'd be happy to share them with them.
Fantastic. Thank you. Okay. Nick says, I heard the federal program was sunsetting in 2021. Is that something you expect to be extended? Nick, we fought very mightily to keep the state credit. This year, it was a huge battle, and I'm very relieved to say that it was extended to 2026 here on the state level. So that is not a concern, at least in the immediate future. I have heard nothing about the federal credit sunsetting. Jason or Nathan, do you know anything about that?
I feel like it always, comes up on both the state and federal level, is, discussing here and there, more so on the state level, which is why, thank goodness, we have the PRC and the Tax Credit Coalition and other bodies like that to tirelessly advocate for these programs and to, prove the economic benefit and the economic driver that these programs are. They every so often they come up in the state or federal legislature, and they, propose making changes to them or making a cap on the amount of credits they'll issue. So, that's why it's good to have watchdog groups like this that stay abreast of those and really lobby on both the federal and state level to continue these programs and prove their benefit.
Clarence asks, can a grant be layered into the process from the city or state programs?
I think so. It just depends on what the grant is and how that works. I can't speak too much about that. I will say that I have been to schools that were being redeveloped with historic tax credits, but also, let's say, had FEMA funding or other funding sources. And typically you can't, I know in some of those situations, you can't earn historic tax credits off of, let's say, FEMA grant money. So there was some pretty intricate structuring of the ownership of the buildings. And I believe that the way they structured it and is that the grants were received and the work was done on the building, and then the ownership structure changed and the work was completed and certified, and that way somehow the benefit was able to be derived ultimately at the end of the project from all of the expenditures put into the building.
Got it. Okay, we have two more questions, and both of them are kind of clarifying questions from topics we've talked about, but the stuff can be kind of confusing. So Dave said, it sounded like a building that is older than 50 years, but not of a historic style would be declined because of a lack of a certain style. Or is it any building that's over 50 years old in a contributing district?
Nathan?
So again, it goes back to, so it does need to be 50 years or older. So, but also it's not really about the style of the building. It can also mean like its historic integrity. So like it could be, let's say, a craftsman building, but it's all been bricked out. So the original wood cladding isn't there anymore. So that building would, even though it's still sort of used as what it is, it's now ineligible. So it kind of just depends. It's not really based on the style of the building, but it's based on the individual building's merits within that district. But yes, it does need to be 50 years or older. So let's say the building is 50 years or older, but there's questionable merits on the building. It'd be good to get a tax credit consultant out there before trying to submit all this stuff. Because sometimes sometimes what you'd think would be a shoe-in would not be, but other times a building that is a more simplified one would be. So I don't know if that totally answers your question, but I'd be happy to, if you have a building, go over that with you.
Yeah, and I just, for clarification, want to say sort of that 50 years old or older, that's kind of a minimum requirement. So it's like, if the building is not 50 years old, it does not qualify, just a flat no. If it is 50 years old or older, then it's kind of like, okay, go to the next step. Let's explore further. So, you know, there's mid-century modern buildings, brutalist, there's French Quarter revival style. I mean, that, you know, it doesn't have to be necessarily what you would think of as a, you know, a bracketed double shotgun or a single shotgun or a camelback, you know. There are many different architectural styles, and as long as it is 50 years old, located in the right map area, and it still retains enough historic integrity, and we can prove that it was built during the period of significance. Those are all of the factors that come into play. And you know, sometimes buildings that are located in the right district and are of the correct age and were built during the period of significance, they could have been altered so much to where at first glance they wouldn't qualify. But after some exploratory demolition, or perhaps taking off a later added facade, you know, like the Pythian building, or let's say you have a more simple building, a shotgun that at some point has been cladded in brick in the front, you know, behind the brick are the original wood weatherboards there. Well, then, you know, perhaps you want to take all the brick off and prove that, or take some of the brick off and prove that, and then it could qualify. So, you know, these buildings are old. A lot of them have had layers added to them, some layers taken off, and it's just about advocating for, you know, it to qualify and how much integrity is there. And again, that's where having a trusted professional who knows these kind of tricks of the trade, so to speak, can really push it forward and push the conversation forward with the State Historic Preservation Office or the National Park Service. And, you know, when we feel strongly about a building and, you know, do our research and get our data points, I mean, we, you know, we'll go to bat for our owners, and, you know, we'll do it respectfully. We have working relationships with these reviewers, and, you know, we're not going to stick our neck out too far on any one of these projects. But I mean, we're also, you know, passionate preservationists, and, you know, we will go to bat for people's projects when we feel strongly about it and we feel like we've done enough research to prove our points about its integrity.
Thank you, Jason. All right, last question of the evening. And again, this is kind of a technical clarification. With a double where it has two addresses, but it's one building, can you have one address be income producing and then the other not and still meet the 5-year holding criteria?
Yes, addressing doesn't really matter at all. I assume if it's a double with two addresses, one for each unit, that if they're saying, well, I guess there's two scenarios. One is that the unit that's not income producing is owner occupied. And so I think we've already sort of covered that. The other would be, and I don't know for sure about the question, but I think it would mean maybe in the unit that it is not going to be the tax credit unit, the income producing unit, that perhaps whatever work that they want to do in that unit would not conform to the tax credit guidelines. And in that case, the answer is no. So, you know, as opposed to HDLC, which if you're in a full control area, they govern only the exterior of your property, which is visible from the public right-of-way. The tax credit program is all encompassing. So they have purview over everything on the exterior and the interior of the building, and it's an all or nothing proposition. So either you want to do the whole building inside and out according to the guidelines, or you don't, and there's no middle ground. There's no, what if I, you know, do the outside and this one unit according to the guidelines, but I'm going to do, you know, I'm going to go rogue on this other unit. Like, that doesn't work. It's all or nothing, you know, because they're the ones that hold the carrot. They're the ones that are giving you this substantial benefit. And so, you know, they have purview over the whole thing.
Great. That's a good clarification. Thank you. Well, Jason and Nathan, thank you so much for your time and your expertise tonight. It has been truly a pleasure learning about all of this with you all. And I hope that you all will reach out to Nathan and Jason if you have additional questions. Again, their contact information is in the chat box. Thank you, everyone who viewed tonight, for sticking with us. I hope you'll tune into more of our PRC programming. And of course, check us out on our website, prcno.org, to become a member, to sign up for our e-blasts. Follow us on social media, Instagram, Twitter, Facebook, and keep apprised of what we have going on. We look forward to seeing you at our virtual holiday home tour. Thank you so much. Good night.
Thank you. Let's do some projects.
All right.
Thanks, all.